objectives of financial reporting? Is financial reporting really required? And if it is required, what are the various things that any financial reporting need to address? Then, who sets these standards? Who sets these standards for financial reporting? And who enforces them or implements those standards? Who has the responsibility of setting the standards of reporting? Who has the responsibility of implementing the reporting standards? Who are the regulatory authorities who typically implement these financial standards? We'll try to look at them. And is there any kind of convergence across the world in terms of the usage of the standards, or each nation is having its own reporting standards? What is the kind of integration that is occurring across the various reporting standards globally? So, giving a rise to the IFRS framework, International Financial Reporting Standard Framework, let's try to understand some basic aspects of that particular framework, some characteristics of it, key characteristics of that framework. On a broader level, let's try to understand the IFRS framework. If at all there are some kind of constraints on that, as per that framework is concerned, trying to understand what are the various elements that need to be reported as per the framework, and any other kinds of requirements that are there specific to this IFRS framework. Let's try to understand them. And what is the kind of convergence that is apparent globally towards this IFRS framework? What is the kind of acceptability associated with this IFRS framework? All these various aspects we will try to understand. Then we would try to spend some time in terms of understanding what do we mean by effective reporting. What constitutes, what are the key characteristics of effective reporting, and what are the key barriers that impact the effective reporting? Then some kind of comparison on a broader level let's try to do between IFRS and the other frameworks, especially the US GAAP or any other reporting frameworks that are existing across the world. We'll try to see what are the kind of key differences that are existing, and finally we would try to focus on whatever are the reporting standards that are evolving, the new developments that are coming in the reporting standards, especially with respect to the new products, or especially with respect to the new transaction types that are introduced. With respect to all these things, how are these handled typically on a day-on-day basis? All these are various aspects that we are going to look at in this particular session. So we'll start off with a basic understanding of the overview of the financial reporting standards. So the key objectives. So we'll start off with the key objective of the financial reporting standard, right? So as we already know, the key objective of financial reporting, any financial reporting, whether it is IFRS or GAAP or whatever, the key objective of financial reporting is to provide some kind of information to the investors, creditors, and various other stakeholders regarding the performance of a particular firm. That's a key thing that is being provided as a part of the financial reporting. So it gives a good picture about the past, performance of the firm, it gives the current performance of the firm, and it also provides something to do with the futuristic outlook through the various reports that come out through the various MD&A and various other documents that come as a part of the annual report. Now, the main intention is this financial reporting. Can it be done by the firms in their own manner, or should there be some set of standards for providing the financial reporting? See, the financial transactions are pretty much complex. There are wide varieties of transactions. So the whole financial transaction space is very, very complex. The kind of estimates that may have to be used could be completely complex. The assumptions which may have to be made can vary from organization to organization. So, if standards are not there addressing all these things, we could see that the firms can start reporting in their own manner, which would be completely inconsistent with each other. Right? There is a lot of inconsistency in case the standards are not reported in a standard manner. So, the intention of the financial reporting standards is to come out with a few set of alternatives. Instead of a large gamut of anything can be reported, few set of alternatives or few set of possibilities in which the financial statements can be reported. So someone has to develop the standards in such a way that almost every transaction can be reported more and more consistently by different companies in different industries, and it has to have similar meaning in all the contexts. Any financial transaction with the standard of the presentation, it should carry the similar kind of a meaning in different organizations in different contexts. So, so while on one side providing that kind of policing or standardizing, on the other side there should be some amount of a flexibility also built into them, so that some numbers can be left to the discretion of the management purely based on the kind of business they do. So the intention of development of the standard should be in such a way that they should try to address almost all the transactions, bring about consistency in the various financial transaction reporting across the periods, and along with that provide some kind of a flexibility so that the management can operate with its own estimates and assumptions which are more and more specific to their business. And on the other side, a good financial reporting framework should even help the analysts to evaluate the financial statements of the companies more and more consistently, and probably get into the valuation of the firms in a much more effective and consistent manner. So these are some of the important objectives that come out of financial reporting. And coming to who would set these standards, now we came to know that standards are very much required because of the complexity that is there. So generally we find the standards are set by some kind of private organizations who have lots and lots of expertise with respect to the various financial transactions, containing a pool of accountants and auditors who will typically get into the setting of the various financial standards. And on the other side, there are government organizations which are regulatory bodies which have the primary responsibility to validate these various accounting standards and take the legal responsibility of the implementation of the financial standards. It is to ensure that these have the responsibility to ensure that every organization implements these various standards and prepares the financial statement in adhesion with these financial standards only. So coming to the standard setting bodies, we see Financial Accounting Standards Board, which is setting the US generally accepted accounting principles standard. Then we have International Accounting Standards Board, which is primarily developing the standard called International Financial Reporting Standard. So this is more focused towards a global standard, trying to bring about some kind of convergence across the various accounting standards across the world. Similarly, like this, we find so many different accounting standards across the world. Different organizations setting up different standards with respect to different financial transactions, and now because of the global operations there is a need for some kind of convergence across these various standards. So from any perspective, when we look at the standard setting, all these standards need to be highly professional, right? Any kind of standard setting body, we need to see that it is highly professional, not carried away by special interests of some specific parties, right? That's a kind of professionalism that has to be maintained. Then all the body has a good amount of authority, the resources and skills and competencies to develop, to understand the various financial transactions and try to come out with an effective framework. And the process should be very much clear, explainable, consistent across the years, across the various kinds of organizations. The framework should be clearly in place. If at all some standards need to be added or subtracted or deleted, a proper framework needs to be there in place, and the whole body should be able to work more and more independently. More and more independently, though some kinds of inputs are taken from the various stakeholders, the body should be working more and more independent, and any decision that this body is making with respect to the standard, this decision should be more or less in the interest of the public. So all these are some of the important necessities, especially with respect to setting of the reporting standards. Whereas on the other side, we look out for the regulatory bodies which are more and more government promoted. We see a Securities Exchange Commission in US, Financial Services Authority in UK, and